Did you know out of the 700,000 businesses started every year in the US, only about 2,000 of them raise venture capital? That's 0.3%, or 10 times lower than the admissions rate of a top university like Harvard or Stanford. Startup fundraising can seem like an intimidating, opaque, and unfair process. In this video, I'll try to demystify that process and talk about how to successfully raise money for your startup. I'll answer common questions like whether you should raise venture capital, when's the best time to do so, pitch deck tips, finding the right investors, and what to do once you get an offer. Hi, I'm Wayne. I've been a venture capitalist for about 7 years, starting by interning at one of the oldest and most storied venture funds, Kleiner Perkins. And today I'm a partner at Signalfire, which is a new kid on the block billion-dollar venture fund built using technology like the startups that we invest in. Over the last decade, I've been lucky enough to have met with thousands of founders, many of whom have gone on to raise hundreds of millions in venture capital. And in that time, I've learned a few things about fundraising and what works and what doesn't. A lot of this is tribal knowledge that's not widely understood. And as someone who is an outsider to Silicon Valley for many years, my hope is to level the playing field as much as I can. As a general principle, you should try to get as far as you can without money. Most investors are looking for as much traction as possible and willing to pay for it, both because they want to back the company that's least risky, furthest along, and most likely to be the winner in a market, but also because it shows you can execute with limited resources, which is arguably the very essence of entrepreneurship. From the founder's standpoint, taking venture capital comes with strings attached. You're signing up for rapid growth expectations and pressure to spend aggressively to hit the next set of milestones you need to raise yet more venture capital. That's a treadmill you need to be sure your business is ready for. And as you think about timing, a valuable exercise is to list out all the hypotheses that need to be proven true for your future vision of the world to materialize. Maybe you need to prove there's some new technology that works the way you think, or that consumers are willing to come back and use your product on a repeated basis, or that you can deliver that product in a cost-effective way. You can create much more specific hypotheses for your company, and then one by one figure out how to test and de-risk some of them without money. Investors want to see evidence you can be scrappy in testing those ideas and learning quickly. One thing I hear often is this notion that you need to raise money so you can hire and pay co-founders. Arguably, the single most important thing you're going to need to do as a founder is recruit. Your core team, including a technical co-founder, needs to be in place when you pitch VCs. They're going to be looking for evidence that you can recruit top-notch talent like that Google engineer who could be making 200 grand at Google, not by throwing money at them, but by convincing them in the value of your company's future worth and therefore equity. Now, there are things that money can accelerate, and that's why most successful tech companies do raise eventually. But remember that you should aspire to de-risk as much of your business as you can without money. And if your business is seasonal, like say education software that sells like hotcakes at the beginning of the school year, then that's the best time to raise your round. More generally, you want to make sure that you have a strong case, you're at an inflection point in your growth. And it's really important that you understand from investors what milestones they're expecting from your specific company and stage. Even if you hit venture fundable milestones, you have to plan for a fundraising process that could take you 3 or even 6 months from first pitch to money actually hitting your bank account. That encompasses everything from preparing for a fundraise, which could take a month, to actually finding and meeting investors and working with them through a diligence process, which could take several months, to finally closing a round, which could take a month itself. And during that time, you ideally want to dedicate 100% of your attention to fundraising so you can get it out of the way and back to building as soon as possible. And lastly, remember to plan around holidays. It sounds silly, but a lot of venture capitalists go on vacation. So there's 2 lulls during the year in the month of July and starting around mid-November through the beginning of January, where it can be really hard to schedule meetings and you can lose steam. Okay, so now you decided to raise venture capital. Let's talk about the process. The first step is to create your sales pitch for your startup, typically in the form of a PowerPoint deck. Keep it simple, 10 to 15 slides max that covers the basics, and save the details for in-person meetings. Most pitches generally follow the same structure, like the templates I'll link in the description below. You need to cover who you are and why you and your team are uniquely suited to build this specific startup. What's the problem you're addressing and why that means it's an enormous market? How are you going to solve the problem in a way that's 10 times better than the competition? How do you make money very profitably one day? What have you done so far to de-risk the business? How you're differentiated from competitors, and then how much money you're raising and what milestones are you going to hit with that money. It's not enough to just check the boxes. You need to weave everything together into a compelling story that feels authentic to you and emphasizes your strengths while proactively addressing the key risks and common questions you know VCs are going to ask. And remember that at the end of the day, your goal is to convince investors you have an unfair advantage in unlocking an unmet billion-dollar market opportunity. Quick tip, treat your pitch deck like a base template and customize it. Have a short teaser deck cutting out any sensitive information that you can send over email, and a more in-depth deck for in-person meetings, which you can adapt for your audience. You should be lasered in on understanding what specific questions each VC cares about, and then shape your content accordingly. Another common concern founders have here is just sharing their secret sauce with VCs. Don't ask a VC to sign an NDA. VCs see thousands of decks per year, and if they sign an NDA to see all of them, it'd be impossible to keep track of. And in any case, the ideas themselves, while important, are meaningless without execution. Next, you need to make a target list of investors that you want to speak to. You want to find partners that can lead rounds at your stage, are bullish about your sector, and will be good value add partners to you. There's so many free tools out there that you can lean on to find those partners. Crunchbase, AngelList, PitchBook, SignalFX. An easy way to start with those tools is create a list of businesses that are most similar thematically to yours. For example, open source developer tools or companies that serve the creator economy. Then find the venture firms and partners that led rounds for those companies which match your current stage. Just focus on lead investors for now. Once you have a lead, the rest of the round falls into place really quickly. Make sure though that this venture fund hasn't invested in any directly competitive companies. Otherwise, you're wasting that investor and, more importantly, your time. And if you're located outside of a major tech hub, you may want to consider starting with geographically focused investors in your backyard. Now that you have a target list, you need to find the best way to get in touch with those investors and ask for a meeting. Best case by far is a warm referral from another founder that's been funded by that VC. Ideally, a founder that's made that VC a lot of money before. Second best is another investor or a friend of a VC. Just make sure that any investors who refer you aren't competitive at the same stage. Otherwise, it's going to come off as a negative signal. Dead last is a cold email. I hate to say it, but most VCs get bombarded by inbound and they don't usually respond to them. So find mutual connections on LinkedIn to get those warm referrals. And remember, quality over quantity. A strong referral is probably 10 times more likely to result in a meeting than a weak one. Make referrals easy. Create a short 1 to 2 paragraph elevator pitch with a link to your deck and an email that your contacts can use as a starting point in reaching out to investors. Once you've exhausted your connections, keep building your network at other startup events and ask other founders what VCs they recommend that invest at your stage in your sector. If you do any cold outreach, make sure it's heavily personalized so you can cut through the noise. Now, after you've sent those emails, investors who are interested are going to ask for a first meeting. From there, if all goes well, you'll have more follow-up meetings, often escalated to the right partner who can be your deal sponsor internally at that venture fund, before a final meeting with the firm's entire partnership, which is the last step before getting a term sheet. Your probability of getting funded increases exponentially with each gate that you pass. It's not unusual to meet 50 or even 100 investors as part of a fundraise. So you need to keep track of them in some form of a CRM. Could be Google, Notion, Airtable, whatever you prefer. I'll link a few templates in the description. Keep track of where each venture fund is in their process, next steps, and any key questions that they've raised to you. Try to batch investor meetings in groups of 10. I found that's about the max that most founders can comfortably handle at any one time. And as venture firms pass, don't take it personally. Ask them for feedback and incorporate those learnings into your pitch, and reach out to the next set of investors. Quick tip, in the first batch, try to practice your pitch on safety net investors who aren't necessarily your first choice, and friendly VCs you know well enough to give you honest feedback. And if things are going well and you're getting follow-up meetings, then start graduating yourself to your dream investors at the top of your list. And keep in mind that you want to get to decision maker as soon as you can. You can talk to junior investors like associates, VPs, and principals. Just know that if they don't escalate you to a decision maker really quickly, it's likely a dead end. And just like any sales process, always be closing. Make sure you leave every meeting with clear next steps and follow up aggressively. Your goal is to actually get to a yes or no as soon as you can so you can move on. Worst case is you spend time with a VC that hangs around the hoop and wastes your time. If you followed up with a VC multiple times and you haven't heard from them in a week, cross that lead out and move on. The single toughest part of fundraising can often be just managing your own psychology. VCs only fund a handful of thousands of companies they meet with each year. Parker Conrad, founder of billion-dollar company Zenefits, has publicly said he pitched 60 VCs for his first business and got exactly 0 offers. There are so many unheard stories like that buried in Silicon Valley lore. Even a good fundraise is likely to start off with a number of no's. I found it helpful to frame fundraising as an opportunity to get a free sounding board for your ideas from people who've seen thousands of them. If your objective is to learn rather than just get money from that person sitting across the table, that can make these meetings less adversarial and stressful, and you might actually learn something along the way. Once you get your first offer or you're expecting your first term sheet, you gotta kick into gear and try to catch the rest of the VCs in your pipeline up to the finish line. Your goal is to create a competitive bidding process for your round. That gives you the best chance to have the leverage to diligence and pick your ideal partner and get the best terms you're looking for. Don't make the mistake of setting a price yourself. Say you're letting the market price your company and let each investor propose the terms, and then you can begin negotiating from there. Be careful of over-optimizing for valuation though. It's a natural thing to focus on because it's a measure of how much your company is worth, but there's actually other terms like liquidity preference and veto rights that could be even more impactful for your business one day. I'll be making a separate video for understanding deal terms like convertible notes, safes, and equity rounds, which I know can be really confusing. It's also important to note that often the highest valuation is often offered by the least valuable VCs who have to win by paying more. So do your homework on VCs that give you an offer. Do references from founders they've backed before and spend time getting to know them. Date them before you get married because the investor-founder relationship doesn't have an out clause. There's no divorces, so you better be willing to have this person on your cap table for the next decade through good times and bad. After you choose a VC and sign a term sheet, make sure you don't fumble the ball at the 1 yard line and push it to successful close. Once you finally get that wire and see the money in your bank account, then you can celebrate an important milestone. Congratulations! You're one of the lucky 0.3% to get venture funding. Now the real work of building your business and making your personal dent on the universe begins. If you found this video useful, hit the like button and drop me a comment on anything else you'd like to see. Happy fundraising, and I'll catch you on the next video.